Hi, I'm Aoife Devitt, and welcome to today's Markets Happy Hour podcast. I'm recording this at around 3 p.m. on Friday, June 27th, 2025. It is our second podcast of the week. We had a podcast on Wednesday morning, which was a bonus episode featuring Kawa Hassan, who is an expert on Middle East affairs. And I'll touch on that a little bit later in the podcast. But we will definitely advise tuning into that given the flashpoints that we've seen geopolitically. I'm recording this from France today. I'm in INSEAD at my 25th year business school reunion. And next week, I will reflect a little on what the economy looked like 25 years ago and where we've come from here. But for today, we're firmly focused on June 2025. As usual, I'm going to share the slides, and I've entitled today's presentation The Calm After the Storm. As if this were a chapter in the year of markets, what would this chapter be? This chapter is definitely the one of calm. If we think about how the different chapters of the year so far have read, we have clearly had the ebullience in the aftermath of the election and the expectation of a very pro-cyclical, pro-business Trump administration. We then had some nagging concern that the threats around tariffs were likely to be implemented, and markets started to give back some of those gains, and the non-US markets started to perform well. And that was the beginning of some form of erosion of US exceptionalism, at least the thesis around that, but nothing too drastic at that point. Building up then to the well forecast Liberation Day, we had much more volatility creeping into markets, more underperformance. The immediate aftermath then of Liberation Day, before the announcement of the stay on tariffs, that's when we had the real crisis of confidence that was around what the magnitude of tariffs could be and their impact on the global economy. Moving on from that, then we had more shocks in the form of geopolitical shocks. And the latest one of those was just in the past week, less than a week ago, when the US was involved in using its bunker bombs in the spat between Israel and Iran. That now has resulted in a fragile ceasefire that still seems to be in place. But we are now looking at a chapter which is now calm and a seeming shrugging off of some of the concerns that occupy the market earlier in the year. So with that in mind, it is important to think hard about what we are now looking at in terms of the year ahead. Have those concerns gone away? Are markets being overly enthusiastic? And where do we really stand in terms of fundamentals? As usual, we'll talk about inflation, interest rates, geopolitics, equity markets, and other asset classes. And in this week, we've spoken already about the episode we did on the Middle East. We talked about the showdown there, which has turned into victory. And now it looks like all the indicators are aligning well for a very positive outcome for Scott Bessent. It seems that many of the indicators he would look at, such as the US 10-year, the US dollar, the stock market, and the oil price, all seem to be aligning with what might be deemed to be a grand plan. I would suggest that some of these aspects are not actually aligning, that they are more coincidence in their manifestation. But we will look at that from here. Then the equity markets are clearly surging. We're seeing them reaching new highs in the US after quite a spell or shock of confidence throughout the course of the year. And we know that bond buyers remain scarce, and that despite the fact that we've had a little bit of a rally in bonds just recently, we haven't seen that overwhelming confidence in certainly long dated bonds that we would expect to see, even as a risk off trade, in light of some of the concerns that we're seeing. We've seen that actually both equities rally and bonds have a little bit of a rally, but nothing that we would expect. And then we'll look at the portfolio implications of some of the other asset classes and how they have been performing. As far as the market watchers are concerned, it does seem that tariffs are now off the agenda. We are reaching the 90-day point. There's every indication that the 90-day stay on the tariffs being implemented is not likely to be extended, even as long as a year in some cases. Clearly, geopolitical events dominated the headlines in the recent week. And we can see from this chart that we're not seeing as many stories occupying the media at the moment, the blue line being the Iran story count and the tariff trade war story count really diminishing to close to zero, as if it is no longer topical, no longer news, so no longer a source of concern for markets. This would be perhaps still a concern if there was some meaningful relationship between tariffs announced to date and inflation. We're not yet seeing that, perhaps because the tariffs haven't in fact been implemented. So for now, tariffs a little bit receding in terms of an important issue for markets. As far as the economy, though, despite the fact that we're now seeing those highs in the equity markets, I'd say the economy can only be described as humdrum. In the revised GDP estimates for the first quarter of 2025, the US GDP has been revised downwards. It's now actually slightly negative. We do know that the first quarter was a little distorted because of import and export distortions due to the belief that tariffs were coming into effect. But nonetheless, a negative growth, negative 0.5% for first quarter, not what the numbers had stated they were, and nothing too staggering there. We also know from the Fed that the pace of job creation has said to be slow and disappointing. So even though we're not seeing a cratering of the employment numbers or any notable spike in unemployment, job creation itself is not particularly strong and would not suggest that we're in that upcycle of the economy. And furthermore, we know that jobs will be under threat from AI, and we have seen announcements of downsizing and layoffs, all of which has actually been rewarded in equity markets, but will no doubt have an effect on the employment number in a lagging way. In terms of other economic flashpoints, because we have moved a little bit away from geopolitical flashpoints just here at the second half of the week, we know that the Fed is still very much in wait and see mode. It stated that at the last meeting, it stated that in the press conferences. It is good as admitted the uncertainty that is now at the forefront of their thinking, and they are still waiting and seeing, and they've no alternative to that. One little wrinkle in the news flow regarding the Fed was the announcement that, or at least the suggestion, that the US president would appoint a successor to Jerome Powell earlier than had been thought. That doesn't mean necessarily that that new successor will take the position earlier than thought. It seems at this point that the Chairman Powell will likely stay to the end of his term. However, announcing a new successor does take some uncertainty out of that. And just like a new president pending the inauguration, investors start to discount in the new president's policies. We think also that the policies of the new Fed chairman will most likely be discounted in by Fed watchers in the run up to that replacement taking their position. So the Fed is in wait and see mode. We do know that there is still a nagging concern around the debt load in the US that has not gone away. If anything, the big beautiful bill is only destined to exacerbate some of the problems around the budget. So we know that that's coming. And there has been this exodus I mentioned before. Where have all the bond buyers gone? Exodus from long-term bonds in the light of the potential for inflation to remain high. We know that fixed income is not generally considered to be a good hedge. It's certainly not a good hedge in the case of inflation. So not necessarily a safety trade at the moment to be in long-dated bonds. And the further point we've learned is that US good exports have tumbled by the most since 2020, as Trump's tariffs had disrupted trade. This is the numbers for the first part of the year. And the interesting point here is that we did think there would be some distortion around trade numbers in the run up to tariffs taking effect. And we certainly saw that in terms of imports into the US that were extraordinarily large as stockpiling took place. Now we see that US goods exports have tumbled, and it's time for another interesting relationship to emerge, which is that it would be highly unusual normally for exports to tumble when a currency of a country is falling and tumbling itself. Those exports are becoming cheaper. That would generally lead to redressing of trade imbalances and more demand for those goods. This is precisely the opposite that's occurring. We've had a falling dollar and we've had a slumping demand for US exports. So all in all, that's probably not the direction of travel that would be optimal for redressing the US trade imbalances. But this, I would suggest, is a reflection of the rhetoric and the uncertainty that has been injected into relations. So again, not exactly business as usual on the trade side, even though the economy and the equity market seems to be behaving positively. In terms of what is the best in trade that is working well, we do know that Scott Bessent has been focused on the US 10-year, the Treasury yield, keeping that down. That is the yield that dictates mortgage rates, dictates most of corporate lending, and he generally was focused on that. That has now been, it's not as low as 4%, but is heading downwards around about 4.2%. So down from its highs, heading in the right direction. Crude oil, again, a big contributor to supply side inflation numbers. That's heading down. It had been quite volatile around the time of the Iranian strikes, but has fallen precipitously just in the days since the ceasefire there. So clearly more at work when it comes to oil, and we'll talk about that a little bit later. The S&P has essentially retraced all of its gains, all of its losses, and has back to its gains. It is back to up 24% since its low in the aftermath of Liberation Day. So for anybody who did bottom fish around that time, a very strong return. And then we look at the dollar, that is close to a 3-year low today versus the euro. So quite a steady decline in the dollar. Where I take issue with this idea of this being a besom trade is the idea that the dollar, a weaker dollar, was part of the grand plan. I think this may have been hinted at. I don't know that the actions of the government drove it down necessarily. I'm not sure that the dollar was driven weaker by any actions that were intentional, more that this reflects some loss of confidence by trading partners, some selling of the dollar, some concern around the budget deficit, and not necessarily anything that was designed by the government. So still a weaker dollar, which given the ongoing persistent differential in interest rates and the higher interest rates that the US Fed has, a highly unusual relationship developing there. When it comes to the general lack of demand for US long-term bonds, I've entitled this Bond Buyers Unite because they are uniting in not buying, in that we can see that there has been relatively steady redemptions from US long-term bonds. Perhaps a suggestion that, again, it's just not a credit-worthy consideration at this point, given where we are. Maybe acknowledgement that we will, that there's quite a lot of uncertainty around the Fed's future action and a preference at this point for the shorter end of the curve, given where rates are at today. Equity markets have been a stunning story, however, not necessarily universal. One of the persistent issues we've had with equity markets in the US for the last 18 months has been the concentration and the heavy concentration among the Mag 7 and tech in general. If we look at the indices this week so far, and I cut this yesterday, so this actually will have seen, which should be going up even more this week, and that we've seen indices reaching all-time highs this week, has been a concentration in tech and financials that has been driving equity markets. Big tech has been back in the news with their AI ambitions, clearly extremely focused on winning that arms race when it comes to AI. And why are financials back in the market? Because we know that there's been a suggestion that the deregulation wave that was promised and the pre-election phase is finally here when it comes to financials. We know that an incoming governor of the Fed has her eyes set on deregulation of banks, easing off the banking sector. There was even a suggestion by Scott Bessent that the reason the private credit industry has grown to over 3 trillion is a reflection of there being too much of a straitjacket on traditional banks, that they were essentially hamstrung by some of the regulations that were in effect. That may be the case. As some Bloomberg commentator pointed out, that would perhaps suggest not necessarily that less regulation is the answer, but that private credit should be brought under the same regulation so that it does not have any kind of shadow banking status or any alternative status. So an interesting twist on the rise of private credit is this may drive looser regulations on the banks, and banks have actually been rallying then in response to this. The chart on the right, which shows the movement of small bank stocks, is an indication of just how, in a way, discriminating investors continue to be, despite the fact that this generally bodes well for financial institutions, this relaxation of some regulation coming. Smaller bank stocks have not themselves recovered from the 2023 credit crisis at the beginning of that year. So there's still quite a bit. This was SVB that precipitated that crisis. There has been both a falling out of favor of small and mid-cap stocks generally, but small mid-cap regional bank financials in particular just seen as being a little bit too complex, too difficult to analyze, too difficult to call what exactly will drive their fortunes. Also, a bit of nagging concern about their exposure to commercial real estate. And commercial real estate and real estate in general, still not a sector that has emerged from this current economic situation looking particularly robust. So when we speak about the rise in equity markets and the stunning return to the records that we've seen before, we have to bear in mind that this is not an upswing that has been universally felt. When it comes to M&A, this could be a little bit of wishful thinking, but we have seen some suggestion that deal making is looking to pick up in the second half as uncertainty fades. Of course, I think uncertainty has faded for about 3 days at this point. I don't think we can say it has been a permanent erasure of all the uncertainty that was stirred up at the beginning of the year. We are not out of the woods geopolitically. We have not seen many shoes dropping when it comes to some of the strain that the uncertainty around tariffs and lack of investment put into effect. I would suggest that the IPO market would need to be operating well for deal making to occur. And that's still suggesting that even though there have been some winners, the IPO market is not itself working particularly well. So I've entitled this Winners and Winners. It has been a good news week for most equity sectors, and certainly the US equity market has done very well. But I would suggest that it is still quite concentrated, and right now it's been felt in the sectors of tech and financials. The dollar we've spoken about many times on this podcast, and the 44-month low now against the euro, quite a staggering decline in the dollar, and is really at this 3.5 year low. It has been swift. It has been meaningful in terms of real erosion of spending power, and there's been no real rationale for the euro to be so relatively strong on the other side. So we know that there have been consecutive cuts in rates by the ECB, and we know that Europe itself, despite this week's commitment to more defense spending, Europe itself is still suffering from significant structural headwinds. So the commitment around NATO spending is unlikely to be necessarily positive for the euro and for the region, but still the currency markets seem to be taking matters into their own hands. We've spoken about oil, and this was also a topic that we brought up earlier in the week in the geopolitical podcast. But when we spoke about why is oil not behaving as either a proxy for risk on, risk off, generally it would be a proxy for fear around geopolitical upset and therefore a proxy for risk off. Why is gold fulfilling that role? And why is oil continuing to be somewhat less, it's expensive, even if it is quite volatile? And that has been quite a conundrum for watchers of this commodity. One of the reasons is perhaps that supply driven. There's a suggestion that there is quite a lot of oversupply in the market. We know that this oversupply may well remain on the sidelines if the economic activity indicator is lower than we would expect. So oversupply on the sidelines combined with just simply other sources of energy, the US being relatively more energy independent, less reliance on the Gulf. It just has not been the same kind of barometer for risk that we would have expected, even though we always look to oil as an indication of where geopolitical risk sits and how investors are feeling about a particular conflagration or explosion of geopolitical risk. It doesn't seem that in this case there has been that much of a concern. In fact, it was the Fed governor's words that impacted the dollar more from news of Iran when it came to how she spoke regarding bank regulation. That was actually more of a more impact on the dollar than anything on geopolitics. So again, does this mean that the markets are more inward looking, more insular today? Have they become immune to geopolitical noise? I think there is a piece of that. There has been this flooding of the zone and inability to focus on much, and that's been perhaps then a desire to just look inwards for what the truths investors recognize are, and that they do know the truths about the fundamentals of companies and their margins and their spending power, their pricing power. So again, less focus on the geopolitics and more on the words of the Fed. I would recommend we look at the bonus episode from earlier this week. I spoke with Kawa Hassan of Shrova Strategies. It was a fascinating discussion around just how the events of last week played out. He spoke about how this did come as a surprise to most in the region, how regime change would generally not be desirable from any side of the conflict, that especially within Iran, the magnitude of that country's population, the borders with 9 countries, the impact that that would have on the region would suggest that definitely regime change would be a worst case scenario. He had set forth how that he saw perhaps an emergence from this a peaceful emergence from the current ceasefire. It would involve obviously close monitoring. He was realistic in that it would not necessarily involve a shift in some of the rhetoric that we're seeing in the region, that rhetoric was more deep seated and perhaps would even be tolerated in order to reach the higher order goal, which was of no conflict and ultimately a diplomatic and a commercially viable solution to the region that would enable areas in the region to rebuild. But I think a very pragmatic and insightful discussion that we had around the geopolitical impact there. So that is it, a slightly shorter podcast for this week. I would look forward to getting back to you next week when I will do a reflection on 25 years where the economy has come from. Slightly longer chapter in that case than the chapter we've just seen. For now, we are looking at a relatively calm set of markets where even the narrative has returned to being, have we actually returned to a situation of US exceptionalism again, that we've moved on from the tariff turmoil, we've moved on from geopolitical flashpoints. The president has emerged looking strong with conviction. And before the summer recess, there is now a drive to get the big, beautiful bill into effect. So I'd say investors can sit and be happy that there has not been any particular shock to the portfolio, despite some of the geopolitical shocks, and equally that staying the course, staying invested, not making any knee-jerk reaction in or out of the market will have been the most sensible course of action. Thank you for tuning in and look forward to joining you next week.